So what are some tax implications of fix and flip? So people kind of have this dream, they watch these HGTV shows and they're like, let's dive in and get crazy. So you want to obviously protect yourself from a financial standpoint. There are mortgages that you can get for that. Generally, they're 25% down. But you also want to consider the tax disadvantages because now you're going to have that income. So if you purchased it and flipped it within a year, then you're going to have the short-term capital gains, right?
Yes.
And so what does that look like?
Yeah, so there's a couple different nuances with real estate investment properties like that are being flipped. If the purchase and sale date are within 1 year, then you have short-term capital gains. If it exceeds that, you could potentially have long-term capital gains. But another thing a lot of people don't realize is that if you're flipping multiple houses per year and you're more, actively involved in it, it's not just an investment, it's more a business for you. It actually subjects that income to self-employment tax. So it rises to the level of trade or business income. And the way that the IRS kind of considers it is you're either an investor, which is capital gains, or you're a dealer, which is subject to the self-employment tax.
Interesting.
And, which can obviously be a significant hit on that income that people weren't.
Yeah, or they didn't consider. And you can write off, obviously, like improvements that you've done to the property. So if you purchase a property and your gross is $200,000 that you made, you can write off those expenses that got you obviously to that amount to be able to flip it. And you can write off real estate fees, commissions, closing costs, things like that. And then you would pay the either short-term or long-term capital gains on that difference.
Yep, the actual gain piece.